So the story is that people are still conditioned to trade as they've traded over the last 10 years. And that is, at every dip, if you close your eyes and blink for too long, you miss the dip and the market only goes up after that. And people were conditioned by that because for 10 years, the recency bias brings us to actually behave that way. The reality this time has been very different, and people have been burned in 2022 trying to buy the dip. That, like, the main way I'm looking at markets next year is that the economy and markets in 2023 are going to be a reflection of the monetary and fiscal tightening of 2022. Top 10 statistically significant leading indicators for the economy. Now, every time that this series has gone below zero for 2 or more months in a row, you got a recession. It's historically basically been 100% hit rate over the last 50 plus years. It's a pretty robust signal. Now we are now at minus 2.7, and this trigger was hit already in August. So we have had 3-4 months already of negative prints. Now, the thing is, in markets, you don't trade against your own view. You trade against consensus view. Right? So the consensus is for an earnings deceleration. The consensus is for labor markets to become softer. Analysts expect on average real GDP growth in the US next year to be 0.5%. So they're not expecting major growth. So the thing is, while the direction of travel might be correct, here on markets to make money by calling a recession, you need to be good on the timing and good on the magnitude of this recession. So it's not good enough to say there's going to be an economic slowdown. You need to be very precise about the size and the pace of this slowdown. And so some of these indicators, as we have seen in the global credit impulse, are pointing really south. Some are pointing south, but more mixed, which would actually be market consensus, which means if you take a position based on that, it doesn't necessarily make you money. But let me walk you through this chart for a second. So what this looks like is US 5-year real interest rates, so nominal adjusted for inflation, minus the equilibrium rates at which the US economy can just deliver its growth, also known as R star. It's an equilibrium real rate that the US can hold. And this equilibrium changes over time. The better the demographics, the better the productivity, the higher is the equilibrium rate. The worse the demographics, the lower over time the equilibrium rate for the economy is. I think it makes roughly sense. So here I'm comparing how 5-year real rates are trading against the equilibrium. And the story is very simple. Anytime that these real rates are above zero, they are above equilibrium. And therefore, as you said, the Federal Reserve is being tight monetary policy. Otherwise, it's being loose. Over the last 20 years, first thing to notice, in most cases, the Fed has been loose. You see the chart here? In most cases, we spend time below zero. Yeah. So the Federal Reserve has always tried to accommodate growth, accommodate good economic performance. In some cases, though, we had a bit of a problem. So the Fed had to tighten up the belt. What happened in every single time? 2000, 2007, 2018, and now today. What happened in every single case is something broke. In 2000, the dot-com bubble burst. In 2007, the US real estate market. In 2018, we had a tantrum in the equity market, and then the repo market broke. And in 2022, we had a massive drawdown in the most frothy area of the markets, right? We had high beta stuff underperforming, ARK, altcoins, all that stuff that you love. Shorting actually was hammered down. But actually, nothing systematic in the US, nothing systematically important in the US has broken yet. That is relatively surprising because if you look at the duration, the number of days that this tight policy has actually been there, here, I was in October counting 113 days. We are now roughly at 170 days already of tight monetary policy, which in the past has always led to S&P returns and high-yield credit spreads to balloon much more wider and be much weaker. This time, we have seen a bit of a drawdown. We have seen wider credit spreads, but not necessarily so. So why is that? And I think the answer to that, XO, is to the fact that in 2021, look at this, monetary policy was so loose for so long that companies could actually lock in long-term borrowing at very cheap levels. And by doing that, you freeze the cycle. So let me explain. When you borrowed and you bought a house with a 30-year mortgage at 3%, XO, and it's fixed rate, you know already what your mortgage installment will be. Even if the housing market is much weaker, unless you sell, you're not going to hit the lower bid. And when do you sell? Only when you're forced to at that point. So when you lose your job, effectively. That delays basically the signaling effect coming from many markets, including the real estate market. A corporate, which was a highly levered corporate that had a business model which was terrible, but as long as they could borrow at 3%, they were okay. In 2021, they got a fantastic opportunity to lock in 10-year borrowing rates at 3 or 4%. Even a junk corporate could do that. They did that to a certain extent, which means that yes, rates have gone up, credit spreads have gone up, but as long as this corporate doesn't need literally the money this year, they can kick the can down the road and try to delay the cycle a bit. And that's what happened. That's what's happening, but you can only delay the cycle for as long. So I think at some point next year, and all my indicators are pointing to roughly March, May 2023, we are going to start to see more evidence of this tight monetary policy playing into the real economy with job losses, earnings drawdowns, etc., etc. Where do we actually stand? And I think the biggest parallel that I can draw with the past is 2001. Let me try to explain why. So, Exo, follow me for a second. Let's go back to 1999. In 1999 and beginning of 2000, anything that had a .com after its name as a company was trading at 150 times earnings, if they had any earnings in the first place. Okay, now close your eyes and think with me what happened in 2020 and 2021. Can you say that Carvana, ARK, shitcoins, altcoins, anything that seem to have a strong risk sentiment behind went to the roof without any meaningful fundamentals backing it? The same excess animal spirits. That's the first parallel. Then in 1999-2000, you had a very strong labor market and you had inflation at 4% pretty consistently. In 2021, you have a very strong labor market and inflation being even higher than that and going higher. So another parallel, the Federal Reserve decided to raise interest rates. That's the reaction. In 2000, the Federal Reserve raised the interest rate to 6.5%. Does it remind you of anything? In 2022, the Federal Reserve raised the interest rate rapidly, the fastest hiking cycle over the last 40 years. Another similarity. Now, in a similar backdrop where in 2000, the dot-com bubble basically burst, exactly like in 2022, all these excess animal spirits were taken off the market and all this high beta stuff had a drawdown. I need to ask myself, given all these historical parallels, what happened the year after? What happened in 2001, which in our parallel would be 2023? Now, what happened in 2001 was that the tightness of the Federal Reserve in 2000 actually was reflected in the real economy. So you had job losses, earnings per share being revised down. You had a proper recession. The Federal Reserve cut interest rates from 6.5% to 1.5%, 500 basis point cut. That's a true Fed pivot. The Fed decided they had done too much damage and they started cutting interest rates rapidly. Assume that this is the same pattern we're going to follow, especially in the second half of 2023. So all this tightness in 2022 is going to get reflected into the labor market, into a recession, into an earnings recession. By the second half of 2023, it also impacts inflation on the way down, because don't forget, every single recession over the last 100 years, Exo, has managed to bring inflation down significantly. The next recession won't be different. So let's say the Federal Reserve by the second half of next year decides to cut rates and they slash rates by 200-300 basis points, a true recessionary pivot cycle. A lot of people are telling me, Alf, that is bullish stocks, that is bullish Bitcoin. I got to buy every risk asset I can. So what I did is I looked back at what asset markets did in the period between August 2000 and March 2001. So in March 2001, or actually, let me take the entire 2001 because it's easier to use as a parameter. So those are the returns that asset classes generated in 2001. Please, guys, remember the Fed cut rates by 500 basis points. The equivalent would be bringing rates to 0% by the end of 2023, beginning of 2024. So if you're looking for a parallel, that's what we're talking about. Please have a look at equity performance. Large cap equity, being the S&P 500, dropped 12% in a year where the Fed cut rates by 500 basis points. International equity dropped even more. The real estate market dropped. Emerging market equities did okay-ish, but they also dropped. The small cap stuff held up better than the large cap, but still 0% performance. The only thing that really made money was US fixed income and cash in general. So bonds did well, yes, of course, because the Federal Reserve was cutting interest rates, and every time they cut interest rates, bond prices and interest rates are inversely correlated. So interest rates go down, bond prices go up, hence the return is good. Bonds did good. Equities did not do well. Risk assets, real estate, emerging markets, all of that did not do well, despite the Federal Reserve cutting 500 basis points. Why? Because we were in a damn recession. People were losing their job, earnings were going down, unemployment rate was going up. You asked me at the beginning of this stream, when do we see a bottom in the equity market? And the answer is when the earnings revision cycle has already been fully digested and when the Federal Reserve has already cut interest rates significantly. That happened in 2002. In 2023, as we start, we have barely begun the earnings revision cycle. We have not even begun the Fed interest rates cutting cycle. We are actually still raising interest rates, guys. So this is not the moment yet to be very aggressive in the macro risk management cycle and to be very long, but actually to be more defensive.